Thank you for joining me this afternoon. For those of you who don't know or are not familiar with the program, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted advice and guidance. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 a.m. The Big Talker. We have a lot of great topics lined up today. Excuse me. Columbus Day being a holiday, the markets are closed, but we've got a lot of. There's not many relevant things going on in the markets this week, but we're going to talk about what happened last week in the market, as well as some tips to help you guys present a stronger mortgage application. Been a lot of problems with people obtaining loans, so we want to help you, before you actually apply for that loan, to set yourself up to have a better chance to get your loan approved. Also, we're going to dive into short sale versus foreclosure, and which one is the sure winner when choosing between those two things. Also, we're going to discuss Refinance America, which is another plan that it looks like his name was Bradeen Gallagher with the Collingwood Group on a potential refinance plan for America and what that would mean if we could get Congress to actually buy into this. Joining me on our panel today to discuss these and many other topics is Louis Cammarosano, the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you about what happened in last week in the markets and as well as what's on deck this week and how it can affect you and your real estate decisions. Louis, how you doing today?
All right, and yourself, Ryan? How's it going?
I'm doing well. We had sunny weather this weekend, so I'm in a great mood this Monday. It's amazing. I told you I have that seasonal disorder or whatever it is, but when the sun comes out, I'm a happier person. So
You feel better.
I feel better. I feel great. Glad to be on the air today. Looks like, interest rates have actually been kind of trending back to the negative lately, Louis. And it's interesting because, I had a phone call last week from a potential client. And she's, I quoted her, I want to say 3 weeks to a month ago. And I had told her, I said, it really doesn't do any good. We can give you a baseline of where rates are going to be today, but we can't lock you in until you have a ratified contract on your property. So, make a long story short, 4 weeks go by, she gets a ratified contract. She calls me up, says, Ryan, I need to get a good faith estimate now. I need to know what all the charges, what rate I can have. And I said, well, do you want to pay lender fees or don't you want to pay lender fees? Obviously, you have numerous options. And what she ended up telling me was, well, your rate seems like it's higher than it was 3 or 4 weeks ago. And I said, well, rates have been trending negatively for the last 4 days. When rates start to trend negatively more than like a 1 or 2 day period, lenders really start to get conservative on their pricing and start to hold, thinking that the markets are going to continue to worsen and they want to protect themselves. And, the big takeaway on this story is that, just because what you read in the media of hearing the interest rates are at all-time lows, last week they should have actually been getting worse. And the media tends to stay about 2 to 3 days behind what's actually going on in the markets. So for you out there that are considering buying and you're hearing that, rates are dropped back into the low threes or the high threes rather, they're actually inching back up. And we have a lot of economic indicators out there that are saying that there's a lot more risk of them trending upward than downward. Louis, with all the uncertainty that's going on in Europe right now, this seems to be the big mover here as far as what's, having more investors buying the mortgage-backed security market. What do you think's going on with Europe, and how do you think that's going to affect us here in the United States?
Well, the way it's affecting us in the United States currently is that people are more uncertain about Europe than they are about the United States, so they rush into the dollar and U.S. treasuries, which pushes interest rates lower. And, the Fed is also doing whatever it can to keep interest rates low. And you and I have been talking for weeks, months, almost a year now.
Yeah.
Interest rates eventually have to go higher. So at some point, markets will figure out that the U.S. treasuries aren't really a good investment if you're only going to get a couple of percentage points, and that interest rates are going to go higher.
Yeah, last week in the bond and mortgage markets, they broke some critical technical support levels, which unless the rate market's footing at the present levels can regain themselves, or we can have some negative news that dumps a lot more money back into the mortgage-backed security market, they can continue to get more and more negative. Now, I'm not saying that this is going to happen. I'm just saying that the overall perception of Americans is that rates have just gotten so low that they're just going to stay there.
Well, they're artificially low because of all the Fed policies and also because of the perceived flight to quality in the U.S. with the treasuries. But they really should be much higher, and it really is a matter of time till they go higher. So anybody who's sitting around thinking that somehow rates are going to go lower and that's what they're basing their decision on to delay, that's a mistake. Now,
Yeah,
there may be other reasons not to pull the trigger, but if you're thinking you're going to get a better mortgage rate, a lower rate, those chances are slim. The chances that they're going to go up are much higher.
absolutely.
Also, if you lock in now, you're in pretty good shape, especially if you get a long-term loan.
Oh, of course you are. And I think that, you know, we talk about this all the time, Lewis. I mean, the bottom line is that you just need to be working with professionals that have their pulse on the market. Following, bankrate.com or a lot of these other websites that present mortgage information that I don't want to say that it's false, but it's misleading. And, to think that you're going to get a 3% rate on a 30-year fixed mortgage, you're pretty much crazy to believe that.
Well,
Uh,
it depends on who you are, what your credit is, what the size of your loan is. You're right. You have to talk to a professional to figure out what you're going to get particularly,
yeah, and
not what you see on a website.
exactly. And the big question is, are you actually saving money by waiting to buy at this point? Like what do you really think you have to gain? From January of this year, the percentage of monthly cost of owning the average price home has decreased 2.6%. So your cost of owning a home has actually gotten better by 2.6% since January, versus the flip side of that, where the percentage of rents that have increased this year is 5.9%. Lewis, you and I have talked in depth about, rising rents and what this means to a lot of people in making that decision whether they should rent or buy. With rising rents, it's making it a much easier decision for people to look towards home ownership.
Of course, if you look at everything is going up except home prices and interest rates.
Right.
So it would make sense that if inflation is driving the cost of food and energy higher and also it's driving rents higher, you're going the wrong way that way. But if you can buy a home that's decreased in price at a low interest rate, it makes more sense to do that than to get an apartment where the rent's going to get raised. Even if it's higher now, it's going to be even higher in a couple of years when the rent lease comes due.
Yeah, and it's
Whereas if you have a mortgage and it's fixed and it's at today's low rate, it's going to be today's low rate in a few months and in a few years as well. Whereas your rent's just going to go higher.
yeah, you're locking in your future cost of basically a place to live. I mean,
Which is your largest expense in most cases.
yeah, and in the DC metro area, I mean, rentals are not cheap, and they're getting more and more expensive every
They're
day that
hard
goes
to
by.
find too, especially ones that are near the school you want to be in and the condition that you'd like the home to be.
You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Yeah, Louis, I think that um, you did talk about, prices that are decreasing, and we have the anomaly of in the DC metro area where we actually have rising prices, interest rates that are being reduced. So it is a little bit different here, but it still makes sense because rents are rising so out of control. A lot of government workers and first-time home buyers, they have access to money, still 100% financing that's out there at unbelievably low rates. And there's a lot more state programs that are coming into effect for first-time home buyers that are allowing them to get into loans that might not even have mortgage insurance, which makes the cost of homeownership get even better. So, there are a lot of different options out there. The national media doesn't really present these options to home buyers. When you're going on just different sites of Bankrate, they don't really show you what all these financing options are. You have to really know the niches, know how to work with these state programs, and identify if that potential customer, if that's you, that fits the mold. If you fit basically the income qualifications, if you live in the geographic area that those programs would be, they're actually presented for. So there's a lot that goes into it, but the best thing to do is reach out. 877-245-2030. That's 877-245-2030. I'd be glad to look at, your individual situation and see if, you are a potential candidate for one of these first-time home buyer programs. There are a lot of them out there at this point, and I feel like, if we can get you locked in, as Lewis stated, into a fixed long-term loan somewhere around, let's just say, the 4% range, depending upon your qualifications, I think you're really putting yourself in a good position financially, not just now, not just five years down the road, but 20, 30 years down the road. we've talked about the inflation, the future of inflation, and the prospects of having this future inflation. It's not going to be a good thing. It's definitely not going to be a good thing. But if you can secure yourself a mortgage around 4% or so, you're protecting yourself from rising costs in housing. It's a great financial strategic decision to make at this point. And housing isn't for everybody. There was an interesting article, Lewis. What was I believe it was CNN Money. They were stating that the Census Bureau had said that the home ownership has seen the biggest drop since the Great Depression, and the rate of home ownership fell to 65.1% in April of 2010, which was 1.1 percentage lower than it was in 2000, and the decline was the biggest drop since the 1930s when homeownership plunged 4.2%. It's interesting because these homeownership numbers, it's really, we don't have to have a 70% homeownership rate in the United States. It's actually probably not healthy to have it that high. I think where there's opportunities, where there's jobs, I believe that obviously the markets are a lot healthier. Here in the DC metro area, we have the jobs, so you have the potential buyers out there. In a lot of these other areas, there's a lot of people that want to sell their homes, but just nobody to buy them.
Well, there's two things going on. A lot of people have lost their homes, so home ownership is down. And then you have, as we talked about last week, the new home buyers aren't there because there's now been a half a generation of people who have graduated college and really haven't worked for a couple of years, so they're not really in the pipeline. It really doesn't matter, as you say, whether the home ownership rate is 70%, 60%, 50%. The question is whether you're in the market to buy a home. It doesn't really matter what the home ownership rate is.
Right, and that's a great point there. The question is, are you, in a position to buy the home? Does it make financial sense for you right now? Not everybody else, not your mom, your brother, your cousin, your uncle.
Yeah, you're gonna buy a house when it reaches 71%.
Right, exactly. I mean,
that's what you're basing your decision on.
But I think a lot of people, these type of decisions, they do base them on other people. And you bring up a great point, Lewis, that it is all about them and their individual situation. I mean, we would have to analyze it completely different from somebody making $50,000 versus somebody making $125,000, and how we would structure that and how long they plan on staying in the house. Were they military? Did they plan on moving in the next 5 years? I mean, because there's so much that goes into giving somebody a mortgage, which is a financial instrument. A lot of people think that a mortgage is just something that you must have and you have to have it for 30 years. The average person doesn't keep their loan for longer than 5 to 6 years without either selling their home or refinancing. So when are we ever going to pay off these 30-year mortgages anyway? I mean, in my view, you should be concentrated long term to be able to pay off that debt so you can live debt free. And a lot of people just take it, and then say, I'm going to pay 30 years. That's what everybody else does. You don't necessarily have to. And with low interest rates where they are, you really can leverage your equity. You can pay down substantially. I mean, I've seen a lot of investors actually start paying down pretty substantially on these investment properties to get themselves in better cash flow positions, because every payment that they make, Lewis, I mean, there's more and more that's going towards the principal at 4% versus at 6 and 7%. So, there's a lot of different things that you can do as a person that wants to buy a home, and you want to make sure that you're getting into the right product. 5-year adjustable rates are, a lot of the time running about 1% lower than your long-term rates. And for some people, that makes sense. And for some people, that's potential savings could be of $200 or $300 or $400 more a month. If you're getting guidance to go to a 30-year fixed mortgage, but yet what your plan is and it's short-term and you plan on getting out of that home within 3 to 5 years, and you're going to sell it, and you're putting equity money down, a large down payment, it probably makes sense for you to consider a 5-year adjustable rate mortgage. If you're in that situation, you're kind of contemplating what you should do. Should you take out an adjustable rate or should you take out a fixed rate? How much money should you put down? Reach out to us, 877-245-2030. That's 877-245-2030. When we come back from the break, we're going to give you some tips to present a stronger mortgage application to help you get approved. Thank you for listening to Real Estate Radio. We'll be right back.